Hello, and welcome to the market update for Tuesday, March the 21st. You have any questions during the week or any questions that I don't get to here in the live class, make sure you send those to Jerry at TradersPro.com. I'll be happy to answer those for you. Well, I thought I'd be getting my voice back over the weekend, but I'm still pretty sick and pretty sure I got COVID for about the fourth time or however many times I've had it now. It feels very similar to the past symptoms that I've had. So I may be struggling this week again with my voice, trying to get through the class. Hopefully it's not distracting, and hopefully I can get through the material without having any issues. But let's go ahead and get started. Obviously, the market kind of feels like it's in a pause mode, waiting for the Fed meeting this week. The Fed meeting will be tomorrow. Well, it's going on today and tomorrow, but the Fed announcement on interest rates will be at 2 p.m. Eastern time, and then that's followed by the news conference. It's the same routine. We see this over and over, and it's really been what the market's been focused on for several months now, and so it's been kind of a big deal. Now, in the past, we've been looking at Fed meetings, or at least over the last few months, we've looked at the market kind of moving sideways, and then you get this Fed meeting coming up, and it's the Fed meeting that the market's going to react to, or the CPI report, or anything involving inflation, or the jobs reports have been pretty big recently. But what we're noticing is that we're getting a little bit of an initial reaction when these events are taking place. So then the market kind of just stalls out again. It starts looking for the next thing again. And so I don't know if the same thing will happen here, but I do want to present a couple different scenarios, because the market is kind of acting like it could go in two different directions, or in either direction, which is not always a good feeling when you're trying to line up trades. You want to have a pretty, not that we can know exactly what direction the market moves in, but typically you can be pretty confident in the short-term direction based on the charts, based on the technicals, and we just haven't seen a lot of that. Even some of the daily price action candles that I like to use so much in my analysis, particularly for shorter term trades, have been less reliable. So it really is a market that collectively as a group, everybody's kind of trying to figure this out. And the professionals, the amateurs, everyone's trying to figure out what the next move is going to be. And this banking crisis is just kind of added to it. Now, one comment I'd like to make on the banking crisis is that over the last, particularly the last week, you've been seeing people come out and give a vote of confidence. You've seen the banks, some of the larger banks, infuse some or put some deposits into these regional banks to try to prop them up. And it hasn't really seemed to work. I mean, they're rallying a little bit today, and they were really oversold, so they're due to get some sort of a bounce or an oversold rally. But it brought to mind, any of you that follow sports, it brings to mind that deadly situation when the owner, the football team or some baseball team, it can be any sports team, is struggling, and everyone's wondering if the coach is going to get fired, and the owner comes out and gives a vote of confidence in the coach and saying the coach's job is fine. You just start laughing, because 90% of the time that coach is going to be fired within days. It becomes laughable. Again, this is from people following sports. You know exactly what I'm talking about. You see this happen over and over and over again. And it kind of feels like that same thing is going on with the banks. They're trying to give this vote of confidence, but it has the opposite effect. It makes people have less confidence when you have to come out and try to project confidence. It just has the opposite effect, and it's how human nature works, and it's kind of sometimes it's kind of humorous. It's not humorous to obviously to the people that get hurt involved or that are involved with banks shutting down and losing money and things like that, but it's funny because that's the first thing that came to my mind is that coaching example that it just tends to have the opposite effect. The owner thinks he's stabilizing the situation by projecting confidence, but it actually does the opposite. And then, like I said, usually I swear it's about 90% of the time that coach is fired within a few days or a few weeks or something like that. So, I said this last Thursday. I'll say it again here that these bank situations don't usually play out quickly. In fact, what happens is they seem to be resolved, and then they come back around later on to be, in many cases, to be a bigger problem later on. We'll see if the same thing kind of happens here, but there's been several examples of this in the time I've been trading that I've seen. Obviously, the big meltdown was 2008. I don't see this as being the same, but I do know how quickly these things can spiral out of control. And what seems like it's not that big of a deal right now could become something bigger later on. So we do have to be aware of it. I know the Fed's going to be aware of it. The problem is that the banking situation, it does have a deflationary effect on the market, but not to the extent of something like unemployment does or a recession does, because you're not really stopping your spending, you're stopping your savings, or you're adjusting your savings. You're moving, you're trying to keep, you're trying to make sure if you have uninsured deposits that they can get insured somehow by spreading out the risk, or so it's not the exact same effect. If people have been coming on saying when banking problems happen, they tend to be deflationary, and they do to some extent, but not to the same extent. But it does provide something that the market kind of needs to battle inflation, which is fear. There needs to be fear to get aggressive or to take chances. That is something that can slow down inflation, and so it will have a deflationary effect. And I think that's what the Fed's trying to figure out for tomorrow. Do they keep hiking? I don't think it for the rate hike they're planning on, which is just a quarter point. I don't think it'll matter either way. But again, I'm not so focused on what the rate hike or not rate hike, non-rate hike will be, but what the market reaction will be. So before we jump to that, let's look at the direction alerts. Still a bear market in the long-term trend. We have seen these with the recent rally over the last few days, or attempted rally. It's been kind of a sluggish kind of rally, but we have backed off of that extreme reversal risk. Now it would take much if the market turned back over again to get back into those levels, but it has alleviated some of that oversold condition, at least from a momentum standpoint and a breadth standpoint. Breadth is still in the high range, but off of that extreme. Sentiment indicators still showing high levels of complacency. Buy-sell ratios are pretty wide still, and it's hard for me to imagine the market dropping too much further when it's this wide, but it can. But that's about as extreme as you get with the buy-sell ratios. Our sentiment indicator here is again off the lows, oversold lows there. So we're still relative. We're still kind of oversold in a way, but not to the extreme that we were last week. And that's what we talked about last week. Is in those conditions, the market would. I remember I said it doesn't necessarily have to rally to alleviate that condition. It can tend to move a little more sideways, and that's kind of what we've seen is a little bit more of a sideways correction or consolidation that's kind of alleviated that extreme oversold condition. Now, when we look at the charts here, so I'm going to be giving you kind of a bullish and bearish analysis here. But the rally off of the lows here has been really sluggish and choppy. You can see it moved up, dropped down a little bit, moved up, and had a couple of days here where we're just kind of in the middle, didn't really move much. Today, even though we gapped up at the open, we haven't gone anywhere. This is definitely kind of a corrective behavior, and the previous move was impulsive. This was an impulsive move down that we had a couple weeks ago. The problem we're running into, though, is now your retracement level right here, I think, was a 6 or 8 retracement of that move down. Now we're moving above that. And so you're getting into that area where it could be a transition. It could, although the chart behavior is acting like it wants to go lower with that impulsive down, corrective back up, the fact that you're now retracing a little bit deeper starts to reduce that probability of getting that next move down. So the more we do rally up now, the more bullish the market will start to look, despite the kind of sluggish start down here. And we've seen it. This was a sluggish start to a rally. It looked more corrective, and it took off. Could be something similar that we see here, where it looks corrective, but it kind of morphs into more of an impulsive looking chart or behavior. And obviously, this is another reason why I don't like these binary events that the market focuses on, is that it's hard to get good, consistent movement from the market. That's why I don't like to do a lot of trading during earnings season. Either the stock's going to go up big or down big on its earnings report typically, but there's nothing ahead of time that really clues you in as to that direction. It's more likely to move up or down. And so you're almost guessing, and hope you guess right if you're trading those situations. And it's kind of a similar thing here, where we're not getting a lot of confidence from the chart behavior. And then we're going into this event where, is the Fed going to hike? Are they not going to hike? And like I said, I don't think it's as strong a binary event, because I don't think it really matters that much. Although with people saying that if they don't hike, that would be bullish, meaning that there might be done. I see the opposite. I see that as being, the Fed's really worried about this banking crisis, and because a quarter point is not that big of a hike, but they're concerned enough about it that they're afraid to even make that quarter point hike. So I think it would have actually a more negative effect. And again, this gets back to something I keep bringing up, and that is that the solution to this is not going to be without pain. Either we take the pain of a recession now that gets inflation under control, and then we work our way out of it, or we get back to a rate cutting cycle because of this banking crisis that kicks inflation back into gear. Because if we start cutting rates right now, there hasn't been enough damage done and by damage I mean to the consumer behavior. People will be right back to spending again, and and then what you do is you prolong it. Now you've got to battle inflation again, and now you're a problem that could be over, or could be most of it being over by the end of the year, or maybe early in the next year. Now it gets prolonged out 2 more years, because you have to start the whole thing over again, so to speak. So, people keep talking about a soft landing where nothing bad is going to happen out of this. I just don't see how that's possible. And to me, I personally would like to just get the pain over with now, and then start building, get inflation under control, have a recession. Hopefully the recession is not too bad, and then start building forward. A lot of the banking problems have been because of mismanagement. People, and this is typical of bullish markets and bullish runs. Anytime you have when the market gets flooded with free money, you get people making dumb decisions out of greed. They want to grab as much as they can. In this case, we're seeing some of the banks that are paying the price for some of their leadership being too aggressive. And it's that old Warren Buffett saying that you can tell you can tell who's swimming naked when the tide goes out. And there's a lot of people swimming naked right now with these banks, and not just the banks. It's other areas that they're looking at too, other companies, and but anyway, so we're not getting a strong clue off of the chart, but I will start to point that out. But what I also look at is, okay, this was impulsive, this was corrective looking, but if you start to retrace a little bit deeper there, especially if you get back up into these levels, you have to start to look at the likelihood that the drop is becoming less likely and the rally is becoming more likely. And there's kind of an area where that shifts, and we'll start to get in that area here pretty soon if the market keeps moving higher. Now, a while back, I did talk about the longer term chart, that if we did rally, could this be kind of a little bit of a double correction right here where we get up into these levels right into here around 430 or so on the SPY. I think that's a reasonable target if the market takes off right here. But it's also important not to think that rally is going to last, unless it starts breaking out above these levels. But it's probably going to be a short-lived rally, and then we're dealing with, still dealing with the possibility that the market drops and takes out those October lows. But part of the reason why I'm a little bit less bearish this week, though, is that we got very oversold on this drop right here, and it's hard for the market to sell off when it's already oversold. And then you look at how extremely oversold the bank stocks are. I mean, that is really extreme. And the bank stocks make up a majority of that Russell 2000 index. So it's like, okay, we probably need to have a little bit of a bounce here before the market could have a bigger drop. One thing to keep an eye on, we'll be watching, is to see, though, if the NASDAQ 100 starts to break down, because that's been what's holding everything up right now. The Russell 2000, we look at that chart, it's you can see it's extremely oversold. Well, it had been extremely oversold. It's come back off of that with the more sideways movement the last week or so, but it got slammed pretty hard down here. It's not that far from the October lows. When one more move down and you're right there. And then you have the NASDAQ 100, which is just the opposite. It's about ready to break out. A longer term chart here. It's about to have a pretty significant possible breakout right here, and it's been looking, a lot more bullish. There's a lot more of an impulsive looking move up, and now it still has a long way to go to get back up to previous highs and things like that. But because this has been leading the way, and you have stocks like Google and Meta and Amazon that are really kind of taken off, and Apple, one signal that you could be starting another move down is if those stocks start to reverse and start selling off, in a big way, because they did, like I said, they've been kind of holding the market. They've been preventing the market from having that big sell-off, I think. And if they start rolling over, then it's a sign that, okay, where do you go now? Because really what's happened now is that money has been coming out of financial stocks and going into big cap tech. They've been going into perceived safety of big cap tech, And it isn't just any tech. It's been the behemoths, the ones that traders feel aren't going to go away anytime soon, and pretty stable. So it's been pretty narrow. And that's usually not a healthy market, by the way, is when you start to see this behavior, these fractured markets like this. Not usually a very good sign. So that's why, well, that's another reason why, over the weekend, there's every weekend now there's new news coming out to try to prop these banks up or what have you. And, my thought process, even though I see the futures up, like Sunday night, the futures were up. And I'm thinking to myself, these bank bailouts or this banking support that's going on right now is not bullish. There's nothing bullish about that. So I just be careful. Just be careful. You see the market rallying a little bit off of some of this news that a new players now coming in and offering support. Like I said, what'll probably happen is it'll appear that it's fine and that it works, and then we may go a month or 2 months thinking that problem was fixed, and then something else will usually happen, because what this did is it really exposed a lot of people that were doing things they shouldn't have been doing. And I don't think we're aware of the magnitude yet. Usually it's just the tip of the iceberg when it starts. It's usually not an isolated case. And so that's why it kind of tends to come back around again. Some of these other people that haven't been found out yet, you're going to get people that are digging. They're going to be digging into their financial statements and see if there's other people doing risky things, and so that's why it tends to snowball a little bit. All right, so the Dow, I don't think it's coincidental that it opened today right at this support level that it broke through recently. It dropped below that. It's rallied back up to that. We want to keep an eye on that for the next few days. If it gets back above there, it could be a little bit more of a bullish sign. But if it holds and it starts to roll over again, obviously that would tend to be more bearish. But the price action today in the Dow at this level is bearish. But like I said, I mean, the price action of the Qs is actually more indecisive, but it's not. It is higher than where it opened, so it gapped up and is trading higher than where it opened. The Russell today is again that price action is bearish. Now this is according to what it looks like right now. This is not what it'll necessarily look like at the close, but if we were to close right now, that would be a pretty bearish candle. We call that a shooting star candlestick formation. Usually you get some sort of a downward move off of that. And like I said, we got the Fed meeting tomorrow. That's the wild card of this. I wouldn't trust any chart pattern or price action ahead of that, because it could be just a false indicator ahead of that event. So you got to be a little bit cautious here not to look too much into it. Bond market, back and forth the last few days. We were up here testing these highs. Obviously, if it breaks above here, that'd be bullish for bonds. If it breaks back down below here, that'd be bearish. But this is more of an impulsive move up. This is more corrective, kind of an ABC as it's kind of pulled back. Had a little bit of earlier today, had a little bit of a stronger looking candle, kind of a bullish reversal candle, but it's faded into a indecision candle, so that's not helping too much there. But at least initially, the action is looking like we should see bonds go higher. We'll see if that plays out. We need a little bit of confirmation on that chart. That we should have a little more clarity on that Thursday with the Fed meeting tomorrow. Gold has been on a tear, although down today, but it's back to, this has been definitely an impulsive move, breaking out to a new high right here. Come back a little bit today. Could be that it's, in a corrective move, ABC correction or what have you. But the gold, that longer term chart of gold still looks bullish, and I would definitely have the kind of the buy the dip mentality on gold longer term, at least for now, because that longer term chart. But there can be a lot of near term volatility in the meantime. But that longer term chart looks pretty bullish to me. Oil has tried to rebound a little bit to today. Obviously got slammed, and this is again something we talked about last week, and I mentioned a few weeks that this level down here, although a pretty strong support area, we broke through that. We want to keep an eye on this area if we rally back up, see if it acts as resistance now. So this is a pretty sharp move down. So the oil is very oversold, much like the banks. And again, this is not surprising. The Russell 2000 is down as much compared to the other indexes because the majority of the stocks in the Russell 2000 are both financial and energy related. See if we rally back up in this area here. But I'm still leaning, especially at how quickly we broke that support level, I'm leaning more towards being more bearish on oil. Oil might have further drop, particularly if we start getting more reports of that we're moving into a recession. That's definitely bearish for oil when that happens. The dollar looks like it's kind of maybe completing a bullish ABC pattern. We had this big move up right here. We had this initial drop. It bounced. It's come back down a little bit, getting a little bit of a bullish candle today, at least as of right now. That could change. But I'm wondering if this is maybe a bullish ABC pattern. We start to see the dollar rally higher. Obviously, we haven't had a lot of clear impulsive corrective movement in the dollar recently that's been kind of not at least not the textbook type of movement that you typically see on a lot of stocks. So it could, who knows, the dollar could continue to drop, but if it is going to continue to drop, and if we are going to turn more bearish on the dollar, what you would look at is that the low down here to the high up here. Where is that 50% retracement area? We're probably near that right now. 618 is probably down here a little bit lower than that. If we start dipping below that, then it becomes less likely this is a pullback within the uptrend, and more likely it's going to come down here and retest these lows again. So that's something we'll keep an eye on here. And it might provide a little bit more clarity on Thursday as well when we have our class. We might have a little bit better idea of how the dollar is behaving at that point. But that's what kind of jumped out at me, is that possible completion of a bullish ABC pattern. The VIX has slammed way down the last 2 days. Again, this is something I've gone over and over the last few times it's done it. That's not. Well, first of all, it doesn't make a lot of sense. A VIX that didn't even get up, barely got up to 30, didn't get above, well, it did get above 30 right here, but got up to 30, which is the minimum just fear level. It's not panic, it's just the fear level. And then it's almost back down to 20 again, and we've got all this stuff going on with the banks and the uncertainty of the Fed and things like that. It just doesn't make any sense. And at some point in time, we're going to, and this is why, again, I don't base my trades off of this, because if you did, we'd be broke if we anticipated every time this behavior repeated itself that it was going to lead to some big massive sell-off. But at some point in time, we're going to wake up and the Dow is going to be down 2,000 points, and it's coming, and it just seems like it's building towards that every time that, because again, the market gets back down to 20 again, I can't see it rallying much further, and so, but I can see it dropping, and so maybe this is confirming. Let's go to the SPX here. Maybe this is just confirming that that this is looking more like it's just a corrective type move. This is more choppy after this impulsive move down. Maybe it is just a little bit of a deeper retracement. But if that VIX gets down below 20, especially after tomorrow, then it's going to be hard to really see that much of a rally. Now, again, it's gone down to, excuse me, below 18. So I'm not saying we couldn't still rally and it couldn't get back down below 18 again. But I mean, look at that. Those are big drops in volatility. When I don't see a reason for that big of a drop. It's not surprising that the market is up and the VIX is down. That's a normal relationship, but it's the size of the move. You've got a less than 1% rally in the S&P 500 and almost 11% drop in the VIX. That's pretty dramatic. So that's something to kind of pay attention to. And the one thing too is just the shape of the chart. This is actually one of my favorite bullish type patterns. Hold on just a second. Excuse me. You get that downward move, you kind of start building a base, and then you look like you're working your way up the right side of the bowl. Well, now the VIX is looking like it's working its way up the right side of the bowl, which is bullish, which for the VIX, which is bearish for the market. And we'll see if this is just kind of building towards that, maybe this is still building towards that possible bigger sell out there. And then there's a couple of leading indicators where this adds to the confusion again of we could go either direction. You look at the SMH, the semiconductor index, tends to be a leading indicator for the NASDAQ 100. This looks kind of bullish to me, where it looks like it's getting ready to break out, although, again, it's a little bit of a bearish candle today, but it's looking like it's getting ready to break out, which would be bullish for the market. But then you look at the transportation stocks. This is the Dow theory, looking at the Dow Transportation Index versus the Dow Industrials. And this chart's looking a lot more bearish, where you've got this head and shoulders formation right here with your neckline. You broke through that neckline, you rallied back up to it again. This could be a little bit of a bearish ABC pattern for another move down. You got the Dow bumping into that. It broke below that support area. Now it's bumping into it as resistance. So again, you got a fractured market, and you get to the point now where it's like, okay, if someone asks you, are you bullish on the market or bearish? You have to say, well, it depends on what index you're talking about, right? Bullish probably on the NASDAQ 100, bearish on the Dow and Russell in particular. That's not a healthy market when you start seeing that. Bitcoin's been unbelievable though. I mean, look at that parabolic move now. I wouldn't go chase it here because you're probably going to pull back. You're at the extreme reversal risk, far right side of the extreme reversal risk. Now, I'm not a Bitcoin expert. Some of you out there probably are, and that makes total sense to you why this has happened. But the reason that I've kind of concluded, that I've come to a conclusion to, is that Bitcoin is basically built around was really built because people didn't trust the banking system after the financial collapse and all the damage that did. People wanted to kind of get more control have a more controlled currency that was not likely to be influenced or could be influenced by central banks and things like that, regulated and all that kind of stuff. And I don't think it's a coincidence that once this banking crisis kicked off, that we saw Bitcoin just start taking off. I mean, and that seems to back that up. That it's a way, you're not well. I don't know how it works completely. Again, I'm not a cryptocurrency expert, but the ones that do try their best to explain it to me. We'll say is pretty secure. I mean, the problems in a lot of the cryptocurrency is not with the cryptocurrency itself. It's with the exchanges, particularly exchanges that are transforming crypto into dollars. People want to go spend what they made in crypto using dollars. Well, you convert it through these banks that do a conversion. I don't understand how that works, but that's where the big problem has been with some of the problems crypto's had recently. But one thing I go back to, if you remember back in here, I made a pretty bold call on crypto where I said, this feels like the bottom. I said it at that point, nobody wanted to own crypto. It was, if you even mentioned looking to buy it, people would tell you you're crazy. That's exactly, when you have a really major bottom in something, that's exactly how it feels. And I remember the class, I don't remember what date it was, but I remember, you can go probably look at the dates around this time. But I mentioned that, hey, you want an example of what a bottom feels like. This is what a bottom feels like. You had this big flush out move that where Bitcoin dropped dramatically down into this area. Go to a 2-year chart probably to see that. And this major drop. And then, so these were all buying opportunities. People thought this was the bottom. Nope, that wasn't the bottom. People thought this was the bottom. Nope, that wasn't the bottom. And it gets to a point where you're just like, how much further is this thing going to drop? And even down here, at first, we were talking about this probably being a correction for another move down. It just felt like the downturn was going to continue. As we stabilized in through here, and like I said, but again, this is why you don't make your trade decision off of sentiment alone. You got to have that backed up by the charts a little bit. And that's why I was careful to say, this feels like a bottom, but you don't go run out and start jumping in with everything. You dabble and you put a little money in, and then you wait for that confirmation that it's trending. It looks like it's trending up, and then you add more. But that had the characteristics of a bottom down here. And now you've got kind of this bowl-shaped move. This was a major breakout area right here because it moved sideways for months right through here. It dipped down, moved sideways for months, and then we broke out of that. Now, I don't know if I chase it right here in the near term because you'll probably get a pullback. It'll probably come back, maybe retest that breakout. And even then, you never know. Nobody can know when an exact bottom is. All I said is that it's exhibited some of those behaviors on the bottom. I would have to prove it, and by proving it, it would be get a pullback, move higher again. Now you've got higher lows, higher highs. It's acting like an uptrend. That's what I'd be looking for. But definitely something to start paying attention to if you're into crypto. And there might be still a few of those exchanges that go under. So don't go find the cheapest crypto and say, oh, crypto's bottom. I think Dogecoin is still trading. I'm going to go jump into that. because it's like 3 cents a whatever. That's probably not the smartest thing to do. I'd probably stick with Bitcoin just because it seems to be the most stable one right now, out of a lot of them out there, and probably the most likely to survive. But there still could be others that get rattled before this is all said and done. So, but anyway, that would kind of explain a little bit of the Bitcoin rally we've seen recently. It's no coincidence that it's made that move with the banks, the instability of the smaller banks. I need to emphasize that too. The smaller banks, although the big banks have been hit pretty hard from a stock standpoint as well. I don't think that's a coincidence there. All right. So bottom line out of this, you know, we could go either way. See what the Fed meeting does. You know, Thursday, if it is looking more bullish and the market is responding more bullish, then we'll be looking at least a couple more stocks into the portfolio. I've only got one in there right now. If it's looking more bearish, we could also add those inverse ETFs to try to profit if the market does go lower. So there are things we can do. But again, we don't want to get crazy. And we don't want to load up, because the worst thing we do at this point is to wipe out our account when we're so close to getting the bottom we've been looking for, where you want to have the majority of your capital to take advantage of it when it finally does bottom out. So the stock I'm in has been performing pretty well. I had a big move yesterday. It's kind of backed off a little bit today. Kind of a little bit of a volatile move the last couple of days here. One thing I am going to do, though, is I was kind of waiting for it because it broke out. We got in it somewhere down here, I think. And it broke out, and then it came back and retested here, Had that big move yesterday. I want to move my stop up. I don't want to get too close. I think if I move it just below this low right here, I was going to move it below that low, but with today's move, I mean, that's a pretty big drop off of this high from yesterday. I thought it was a pretty strong candle, and it came right back inside that big candle today. So I don't want to have it too close to this low. So I thought about moving it below this high right here. And that will actually kind of get us near breaking the stop. So I'm going to move my stop up to 31.45, was I think the high of that day right there, 31.45. You can double check that here. Yeah, 31.45 was the high of that day. So I'm going to go into the portfolio. My original stop was at 25, which was, I believe, down below here. It was down below this area right into here. So we're going to move it up to here. And now we'll be above our entry price. We got in at $30.37. Our stop's going to be at $31.45. That way, you know, at least barring some major gap down or something, if it did go against us here, we should be able to get out at break even. But it's always a good idea to, you know, when the stock is behaving like you're expecting it to behave, to move those stops up a little bit. You know, that's how we're going to lock in. Now, hopefully we don't get stopped out, because it'd be a really small gain from where we've been at, but at least it wouldn't be a loss. So we want to kind of trail the stop, keep moving it up a little bit. And so I'm going to change that stop price here to 31.45. All right. Now a couple of patterns out of the new buy list. Some of these we probably got over before, but General Mills still looks pretty good at 94 strength rank GIS. I like the big drop, and then you have this impulsive move up, and this almost looks like a smaller little bowl-shaped move right here. Now again, you could wait for it to break out of this consolidation for a little bit of extra confirmation if you wanted. It is in a sector that would probably still do pretty well in the consumer staples sector. Another one, it's in the consumer staples sector in that list. That new buy list was Clorox, 92 strength rank. Again, been in a nice little uptrend. Right at a breakout area here too. You could just wait to see if it breaks out. But that's been trending up pretty nicely there. And then I'll do one more here under computer technology. And again, notice how computer technology, the sector has moved up the list. It was down here, and it's moved up the list as the NASDAQ 100 has been outperforming that sector. So again, that's why we look at this list here, is that we go to the sector tab, and it tells you what sectors are outperforming, where the money is flowing into and out of. You can see, we remember oil was up there forever, right? Oil was all the way down here. So, you don't need me to come out and say that money has been flowing out of oil stocks, because visually you can see it right here. That is moved down the list. Money has been, and obviously if you go look at the individual charts, you can see that money's been flowing out of oil stocks, but you can see it right here. So ideally what we're trying to do with the software is stick to, if we're buying stuff, well, first of all, we want a bullish trend in the market. We want the market to look like it's going higher. We don't want the market to be overbought to where it's hard for it to go higher. So we like it that's why we look at those direction alerts. We like to see them in the middle somewhere in a bullish trend. And then you start looking at the top sectors and then the top stocks within the sectors at 98 strength rank or around that 98 strength rank. And boy, this is really fun to use when we're in a bull market condition, because it makes trading pretty easy. Not that trading is easy, but at the very least, it puts you on the right side of the probabilities. It puts you in front of stocks that are moving and sectors that are moving, and that helps your chances right there. That alone helps your chances immensely if you're sticking with the where the money's going. What are the big professional traders doing? Well, that's what this is showing you. So under computer technology, under the hold section, I liked Rambus, 97 strength rank. Again, nice little uptrend, but again, it looks like it's getting ready to break out. Indecision candle today. So again, a lot of these stocks, I'd prefer the confirmation of them breaking out first. But if they can, they can continue to take off. What we're looking at would be the similar what looked at back here when it kind of bumped up against here, pulled back a little bit, then came up, and then broke out. It's looking like it's getting ready to do the same thing again, break out, wait for the breakout. I like that pattern there. And it's in the semiconductors, which remember where that semiconductor chart looked like it's getting ready to break out too. So if all that starts to happen, then that would be a pretty bullish sign. Other thing, but that's why you would wait for confirmation, is the opposite. It could bump into this as resistance and roll over. I mean, this could be an area where it just rolls over. Everything rolls over. Chip stocks, the Dow, NASDAQ 100, what have you. It doesn't break out of that area. That's why these next few days will be pretty critical to see which way things go out of these key levels and key areas here. All right. That's all I have. That's all my voice can handle for today. So have a great week. We'll see you Thursday for the stock-specific class, and hopefully have a little bit more bullish conditions at that point where we can look to add some things even into the portfolio at that time, get things rolling again. All right. Have a great week, everyone. Bye now.